Hey, you there. We know you're working hard, guiding those you serve through changing regulations, evolving business models, getting in front of changing global forces, adopting new technologies at unprecedented speed. Confidence, drive, intuition. You have what it takes to lead.
If I'm to be an effective leader, I need to be always up to date. I need to be rounded up in terms of my emotional intelligence.
Curiosity helps me to broaden my knowledge. I'm used to things changing in terms of my subject matter. And that's why I always try to adapt myself.
For me, I have to demonstrate integrity, transparency, and accountability in handling honest financial matters.
Your superpower? A strategic mindset.
I'm passionate about making a difference. I'm very open to change, and if anything, I like driving it.
We need to give the space the others to say what they need to say, and also to give them the space to understand, because sometimes the words are different, sometimes the meanings are different.
During times of challenges, we tend to stick to what we know best, but do not forget that it is also during these challenging times that we should think innovatively to find new solutions.
You are a problem solver, data specialist, and a mastermind. Your ideas and initiatives drive change and growth. The future of the profession is bright because of those who rise to lead in their own way.
I try to use tools which will help me get my output faster rather than only drawing intelligence from that output.
Advocacy, guidance, resources, serving the public interest, creating opportunity, helping you accelerate and then lead.
I think the next generation has got this wide open world in which they can develop.
Being a member of CGMA has really made me realize that I'm a visionary, because you go through articles that are talking about the future, and I see myself fitting in the equation.
What will be your role in the future of our profession?
Good afternoon. You're all very welcome to today's webinar, Adding Value Where It Counts and Can Be Counted. You will see the Q&A button on the bottom of your screens, and as all attendees will remain on mute for the duration of the webinar, you are welcome to input your questions here, and Leonard will answer them following his presentation. We will be recording this webinar and will provide you with a link via email after the session. We're delighted to welcome back one of our fellow members, Leonard Brown. Leonard has over 30 years experience in finance and general management roles, gained across both privately owned businesses and large corporates. He's a fellow of the Institute, has an MSc in Business Improvement, and is founder of coaching and online training provider Profit Analytics. So with this in mind, I'll leave you in Leonard's capable hands. Welcome, Leonard.
Hi, Jean. Thanks for that. Welcome, everybody. I hope what you're going to hear over the next short period of time is useful to you, and that we can work our way through it. The title, as you well know, Adding Value Where It Counts and Be Counted, which to me is the bottom line. We've a helpful warning I better give you before we start is that this is my view of how finance can add value. If in a number of instances it may or will not necessarily be CGMA's view, or in fact any other accounting body's view of the topic, but we can take it as we go here, and you can see whether it fits with your understanding or not. So in this, I'm going to try to get through the normal sort of slide presentation as quickly and as hopefully without too much padding, on the idea that in live workshops, when I'm doing them, I find that much of the understanding and the learning comes not from the slides that are up on the screen, but from the questions that are asked and from the discussions that go on as a result of that in the room. And I'm hoping today that we can actually do that. As Jean said, there's the opportunity to put in questions and answers, or questions rather, and hopefully I can give some answers to them. Jean will pull them out towards the end of it. We've got a good to talk session at the end of the slides. And maybe we can try and get a better understanding of things and share whatever understanding we do have, or query those things which we either don't understand or don't agree with. So I guess three terms have come to the fore in the accounting profession and publications over the last maybe 20 or so years. First is finance business partnering, and I was with a number of you in March when we went through that. The second is adding value, which is what we're going to talk about today. And the third is ESG, which strangely enough started coming to originally being talked about around the same time, but obviously in more recent years has become much more prevalent. Much of this goes back to, in the first two, goes back to Dave Ulrich, and was contained in a book which he wrote, Human Resource Champions, subtitle, The Next Agenda for Adding Value and for Delivering Results. There's a book which was published in 1996, in which he outlined his idea that you could divide the HR profession into, he used a 2x2 box type diagram to show different roles, and that they could be what he called at that stage the business partner, helping not just look in the more traditional HR role, but to be working with other parts of the business to make sure that we move towards business plans. The query that came up from the time from the HR professionals was which of those four boxes was the HR business partner, and to a degree the water became sort of muddied a bit when he described it as any one of those four or all of the four, which left things maybe hanging in the air a little bit. But to see how things had gone, he went back 10 years or so later and did a review of what had happened in the profession from that had been launched, if you like. And in an article in HR magazine, which was published in November 2008, he wrote, the need for greater business performance has put all support functions under a microscope. They're all trying to find ways to deliver more value and to either increase the top line or bottom line. If they're not delivering definitive value and sustainable value, they've been given the mandate to change, be eliminated, or be outsourced. So just focusing in that end of the sentence there, they're all trying to find ways to deliver more value to either top line growth or bottom line profitability. And that means if we just add the one word to that, because you'd already mentioned all of the support functions, finance is under scrutiny and pressure to create more value. So how might it do that? For the last, since back before we changed into the 20s, we had the model from Porter, who said the value chain explained how the primary activities work together with the support activities to create the business overview and generate the margin. And if we look at that, it is finance is obviously part of that infrastructure at the very top end of it, in both the acquiring of capital and in how it's managed. So if we move on just a bit to see how things have changed since that 1980s, I used an article here from The Independent, which is about 5 years ago. and it showed the SEAT plant in Spain, main plant in Spain, and it showed two photographs. One of how things were in the 1960s and 70s, which, as you can see, would have been the traditional sort of production assembly line for motor cars. Loads of workstations just sitting along the lines, all manned by one or more production workers, as they were at that point. Moved to the right-hand side with the today as it was 5 years ago anyway. And I've struggled to find two persons in that. As you can see, it's now robots. As we would imagine, and as it would be here today, the world has changed on how the production side of it is delivered. And I guess it's changed on how back office has worked too. You know, when you think the cloud now has introduced something which, you know, back in the 50s, 60s, as that motor video showed, it wouldn't have been thought of. We no longer are linked, needing to be tied to the company's own server. Managers can get information wherever they are on more or less what device they are using at that point in time. We've also opened up things in that employees don't have to be any longer where the business is. They can be on the other side of the world. They can be in lower labor cost countries, therefore reducing costs without necessarily affecting the ability to produce what they do. And that applies to outsourcing as well, that those people who are outsourced can be in lower cost economies. So with finances under scrutiny and the pressures to create value for their companies, either in top line growth or bottom line profitability, how might they do that? Sadly, I've seen some ridiculous claims made about value added by finance people, finance professionals who have suggested what they're adding. I've also seen honest admissions from individuals to say, I actually don't know where to start. And for those of you who may have been here in March when we looked at finance business partnering, one of the clips which I showed at that point was a Deloitte consultant who was saying some of the surveys they had done surprisingly showed that something like, I think it was 40% of the respondents said they actually didn't know where they added value in their business. So the best education that I know of for accountants who want to demonstrate the value they add to their business takes just 2 minutes. It's a fairly well-known clip from the Jerry Maguire film, and it nails what really counts in my terms. It's a situation where Jerry Maguire has just been told he's going to be sacked from the sports management agency that he works in, and he's quickly trying to phone around his the sports people that he works with, trying to make sure that they stay with him as the agent who works for them rather than whoever they're passed to within the organization. And he's talking to a guy here who a guy called Rod Tidwell, who's played by Cooper Gordon Jr., and an American footballer. And he's going through the sort of the speed of what's necessary, and Tidwell sort of stops him and said, look, you know, Jerry, I like you. My wife likes you. You're good to us. But there's one thing that you've got to do. And what's that? What's that? Show me the money. And Jerry Maguire sort of repeats it. Yeah, show you the money. And Tidwell says, no, I want you to shout it. So the voice level goes up and he shouts, show me the money again, until eventually he's screaming at the top of his voice, "Show me the money." And at that point, Tidwell says, "Congratulations, you're still my agent." And there's something in there which really says, no matter what we do, what really counts is what we can show me the money point to. Be able to point to something that on the bottom line of the business, to me it is bottom line, but recognize it likely won't be done by us alone. We can't make significant changes on our own without the involvement of other people, other senior managers in the business. So what do we need to start on this journey? Firstly, in my view, a roadmap of where we want to go, just like any other journey. Let's know where we're going. Know the right questions to ask. And thirdly, do some tightly focused analysis. This is a diagram that CGMA used, published 2007, and it's still very valid today. I'll actually describe it a bit more as we go on through. But we start at this point, we do some tightly focused analysis. The aim of the analysis is to reveal something, an insight, as it's called in the diagram, which helps explain why business performance is as it is and how it might be improved. Something which tells us, lights a spark of understanding in us about what we might need to do to improve things and how they could be improved. And what we're going to analyze, we'll talk through as we work through this brief overview. But it's about gleaning an insight and turning it into action. And benefiting from that impact likely won't be achieved by us alone and without good people skills. It's going to need other people involved. We have a limited value that we can actually do on our own. The further we move out of our traditional accounting comfort zones of technical skills, the more value we add. But that means that we need to improve some of us will need to improve our people skills, how we work with other people. It's not going to be necessarily fact-based any longer. It's not something that sitting at our desk alone is going to be able to make happen. And it's something which is perhaps, as I said, out of our comfort zone a little bit. So my thinking at the time when I suppose I was trying to get involved in this heavily was, how do I best go about it? And yes, the cartoon has hair. I've been interested and involved in business improvement and profit improvement for a long time. So there's plenty of opportunity to learn what works and what doesn't, and to build a roadmap that includes a short list of key questions that need to be answered and brings together what I've found to be a toolkit and a sequencing that works. Now, it's not an overnight thing. It was getting a lot of things wrong that said, what else could I do it this way? And the roadmap I'm going to run through now, it's only got 6 questions and 5 different tools. The first question is quite an obvious one, I suppose. It's, is the business busy? Is there a demand for what it sells? Because if the reason it's not profitable is that it's not busy, then we've got to go back to the stage of questioning whether there's a future for it. If I can remember on one occasion talking to someone whose business was quite sizable but was heavily loss-making, and I asked them who else does this, and they said, well, nobody else does this anymore. And you couldn't help but think, well, maybe there was a reason for that. Maybe they couldn't make any money out of it either. So what can we learn from others in our sector is the second question. You know, for years and years, I found benchmarking was really an excellent tool to use. It opened your eyes to what other people were doing and raised the questions, how do they do that? Why do they do that? And could we do that? How you get the information depends where you are, but many of the development agencies will provide things from, you know, for example, from the like of Plimsoll. You can go if you want and build something yourself from the CRO or from the company's house, though I wouldn't advise doing that to start with. You want a list of the performance of companies, which you then can be able to focus down on a bit, and the benchmarking will allow you to pick out those in your sector who are really performing much better and try to understand from a detailed analysis how they're doing that, or what is it they're doing, and then involved with other people to work out how they're doing it. How efficiently and effectively do we sell our key resources? The page that you see on the screen now is actually from CIMA's journal back, would you believe, in 1997. So yes, about the same time as the Dave Ulrich publication. And it was on contribution-based activity, as it says. It was an article by, at that point in time, Keith Cleland, or Professor Keith Cleland, which showed his way of going about trying to help businesses of various sizes understand where the holes were, if you like, in what they were selling. It wasn't very detailed by comparison to activity-based costing. It was very simple. But it's honestly a very powerful thing. What it says is we have a key resource that we sell. Now, you know, take, for example, if you're a furniture manufacturer, is what you sell furniture? Or is it the production hours to create the furniture? Or is it in fact your key resource? If you're a warehouse organization, is it warehouse space? Is it, you know, is it something which, if your biggest problem is working capital, is it how much working capital is tied up in the sale that you're going to make or have made? But there's something which is key to you, which many times we don't identify, and many times we don't measure how efficiently we deal with that. What percentage of our total do we actually bill to customers? At what average rate are we billing it to various customers? And an excellent simple thing to do, which we'll talk about. Next thing that comes up is customers differ. And I'll explain something which brought this home to me at one stage, but customers do differ. And what we've got to understand is what it costs to serve them. And there's a tool which I played around with and sort of pulled out of some of the other ones available, which CPA, like customer profitability analysis, a light version, because if we go fully into activity-based costing, it's a lovely thing for accountants to get involved in because there's lots of calculations and numbers involved, but it's very tedious, very long, and to be honest, can become the problem in itself rather than the solution. But so how it became really a focus point for me was, I can remember sitting in my office at the time at, would you believe, 10:30 in the evening. I had a presentation the next day. And it was going to be the outcome of the first time of using customer profitability analysis. And I was sitting looking at the analysis results, and two major customers for us who bought similar volumes of product, or the similar product at similar prices over the period for which this analysis had been done. And one of them was shown as quite profitable. The other one was shown as a loss maker. And I was trying to understand, how could that be? How could they be that different? Until you started to look at the transaction levels. And there was a very big difference in how they actually bought, how simple it was for us to be able to service them by comparison to the other one. So a lesson learned very quickly, even if it was late evening, about customers differ, so does the cost to serve them. The fifth question we've got to ask ourselves, and the fifth tool that we use here, is a 2x2 matrix, which says we've taken the information that we've got above here, however we've got it, be it from number 3, number 4. So we've got a series of transactions for a period of time, and anytime I've used this, it's always been for the 3-month period. So it's 2x2. The left-hand axis, if you like, the vertical axis is how closely the customer whose performance we've measured fits with our strategy. And across the top is how profitable or otherwise they are. Are they profitable to us? Does a net contribution be suffice for us? Or, as it's used in the diagram, loss making, they don't fit that. So we end up with 4 boxes. And the simple part of it is that if they're profitable and they match our strategy, we want to not only retain them, in fact, we want to try and grow their business. If they don't meet our criteria in terms of generating the contribution that we need, and they match with our strategy, we need to try and find out why that is and change it if we can. If they're in the bottom left-hand corner and they're providing us with profit, but they don't match our strategy, then we want to monitor them to make sure that they still continue to be profitable, but we'll keep on taking the money. And if they're at the bottom right-hand side, they don't make us money, they don't fit with our strategy, then we want to replace them. We often can't afford just to get rid of it immediately because we need a certain amount of volume, perhaps, depending on the business, but we want to replace them with somebody who fits in that top left-hand corner. And the sixth thing really is just using the review of everything that we've done from 2 down to 6 to say, let's look at our pricing. Let's look at our strategy. What do we need to change about it? Is it clear? Does everybody know it? Can it be quoted? And there's an article I've used maybe before, which is, can you say what your strategy is in 40 words or fewer? And how many managers throughout the organization would come up with the same version of it so that we all know what we're doing? And KPIs, and the KPIs which actually concentrate on the key points of the strategy, not just how many numbers can we throw up onto either a page or online for our managers to look at. So in terms of project length, as you know, the vast bulk of projects tend to fail. They don't actually meet their initial outcome or predicted outcome. And what I'm suggesting here is that we limit a project's life to 90 days, and we have clear targets for what that outcome is. Now, I'll explain why that is. Firstly, 90 days have been found to be a good length to achieve a project, so long as you have scoped the project properly. You're not trying to do Mission Impossible. Secondly, you need, while you're involved as a finance person involved with that project, you need the senior management team, those you're going to work with, to be involved with you. They're only going to be involved with you while the most senior person, the CEO, MD, general manager, whatever it is focused on this project. My experience is those most senior people tend to be action-orientated people, and it's hard to keep their enthusiasm for one thing for more than 90 days. So it's important that if we're going to have a project which is effectively driven by them, then we need to do it and have a result within 90 days. And that's very doable, so long as we divide it into the right chunks. In fact, some will never go beyond 90 days in my experience. So if you decide that you're going to undertake all of these 6 elements of the roadmap that I've laid out, you could split them, anything up to 3 90-day projects. Never experienced it taking longer than that, and often it can be done in 2. So that's really my suggestion about how to try and add more value. And as we said earlier, much of hopefully the learning can come from what questions there may be and things which I haven't explained either well enough or fully. So Gina, if you are ready, if there are any questions there, then maybe we can start to work our way through them.
Sure, great, thank you. The first one here is, what size of business does what you've been describing apply to?
To be honest, it works from small SMEs. I'm trying to think through my experience, anything up to maybe 250 in the same business unit, but those business units have been often in large, very large businesses. The key thing really is that the control of what the business does is within their, reasonably within their hands. If it's, if it's a business unit of a large corporate, it's not totally, but you want really to have something which isn't just a production unit, which is sold, the sales being done by somebody else that's not being controlled. You want it within whatever they do within the control of that team that you're going to be working with. If that gives an answer. Yeah.
Great. Yes, thank you. Next one in is, how would you suggest that a finance consultant brings to life for clients that we work? Don't know if that's exactly how somebody wants me to read that. If you want to put that question in again for me, please. It's an anonymous attendee. How would you suggest that a finance consultant brings to life for clients that we work? How about we move on to another one?
Yep.
Leonard, and I'll ask that attendee, please, to rewrite that for me, please. The next one in, is it a good idea to have a balanced team and a 90-day project team between creative people and risk-aware persons?
My experience is that you work with the senior management team. I mean, this isn't a project that's going to need multiple people. You're not talking about bringing teams of people in. You're using, if it was a typical sort of thing, you're going to have sales, maybe sales marketing, depending on what it is, production, finance, maybe HR involved. But if you're trying to focus on something where there is a problem. Now you're starting by trying to find what your business is doing. Firstly, look at others, the benchmarking. So you're saying, who are the businesses that are doing much better than us? And there's a way that I suggest going about that. And then how do we find out what it is that they're doing? Sometimes, to be honest, because they may not be in direct competition geographically with you, regionally with you, sometimes it's a question of asking, and I've experienced that. And they will tell you, because they don't see you as a threat, or maybe they even decide they might like to buy you. But you're going through it. It isn't a big team. The last thing you want is a big team. You want several people involved who can actually get to the nitty-gritty and decide. Big teams, no decisions.
Okay, brilliant. Okay, thank you. So we have the first question reworded, if that's okay. So how would you suggest that a finance consultant brings this to life for clients that we work with?
Really, I guess, to be honest, work through that checklist. Your first thing is, if I were a consultant trying to sell my services I'd be trying to find a business that in a sector that hopefully I even got some knowledge of, that is busy but not producing decent results. I would then be going through step by step of those 6 points, work through each one of them with them. And sometimes, if you've got a finance consultant in because it's a relatively small business, you can get your head around it fairly quickly. You can understand what's involved, and the hope is that you've got the numbers there available to you through their, whatever they're keeping. But things are better today than they were 20 years ago, that's for sure, in terms of access to transaction detail and customers' profiles. Does that answer it, do you think? Work through the 6 steps?
I hope so. If the person who answers or asked the question could just drop in a note to say yes or no, that'd be good. Yes, they said thanks a million.
Right.
Thanks. So next question, please, if that's okay. How do you motivate staff to add value to an organization if the staff do not benefit either financially or from an intellectual property perspective?
That almost sounds like a bit of a loaded question. Loaded in the sense that there seems to be disinterest. I don't know is the answer to that.
Okay.
I guess I would always say if you've got no value in the company that you're working with, maybe it's time to look for something else. On the other hand, maybe it's time to actually show what you're worth by finding a problem and using a methodology to try and sort it out. But that depends on the senior managers and senior manager in singular in that instance, because if they're not interested in sorting the problem out, then nobody else will be.
Okay, thank you. So when you talk about the aim of this analysis is to reveal an insight or insights, what does this mean?
Okay, good question. Insights, really I guess what we're saying is that sometimes within a lot of information, we can find that on particular occasions, not everything follows the norm. And when we go into it, we find there is a reason for that. And the reason is something which crops up because of circumstances, because of products, because of the individuals involved or whatever. But something that says on these circumstances, when these 2 things coincide or whatever it is, then this happens. Now, that this happens may be something that's good. So you would say, how do we repeat that? Or it could be something which is detrimental, which is reducing our profits in some shape or form. And you say, well, how can I avoid that? So you're trying to find something in this overall mass of transactions or data that's there, a particular time, a particular occasion, a particular happening which is out of the norm, but is creating either a good or a not good result. And we're either trying to therefore capture that and say, how can we do it again? Or how do we avoid it? How do we avoid a loss from it?
Okay, brilliant, thank you. Next one in, please, is I have presented information previously, but management have not acted on it. External consultants are then brought in and present the same information and action is taken. How to have more influence, maybe, or how
I understand it well.
Yeah.
I guess the problem that we have, as or not just us, but other professions too, and particularly in the history, is just the diagram which you saw. We have relied very much on our technical skills. Our strength has been in the technical side of things, not the people side of things. Others, and often consultants, will be much better at getting on with people, at saying the right things at the right times, now hopefully truthfully. But if you go back to that diagram, it shows that the value that we add, the more value we add, the less we're within our traditional comfort zones, because we've got to influence people to do things. Now, to me, that influencing people is about understanding people. And I'm thinking now psychological understanding of people and putting yourself in their shoes, because from a finance desk, lots of things seem easy, which when you're in a sales situation, a production situation, general management situation, are not just as easy at all. We've got to find out how people work out how they come through, what their preferred way of dealing with something is. You know, I can think of people who I've worked with who wanted to go step by step through every detail. I can think of others who I've worked with who just want you to tell them how it is and what we need to do about it. I've known people who are very HR conscious. They're thinking of how this will affect their team or their customers or whatever. Know those who are very finance orientated and how much will it cost or save. I'm old enough still to use the Myers-Briggs 16 preference types to work our way through how really should you present something to somebody. And I would suggest maybe it's worth spending time on that. There are plenty of other personality profile methodologies as well. I happen to like Myers-Briggs still, even though it's not new. And you're into how do I pass this information on visually as well as factually, and what can we do to try it? What can I do? Often it's putting yourself in that person's shoes and seeing it from their point of view. So I would try that.
Okay, brilliant. Great advice. Thanks. The next one is quite detailed, so if you need me to read it a couple of times, please shout. In terms of insights gathered from financial information, do you think AI is going to remove a lot of the analytical work over time, as it will potentially give finance teams the data and area to focus, and therefore remove the need for finance business partners potentially, and allowing F, P and A having a larger role in organizations?
I think when I did the presentation in March, I quoted from an Oxford study which said what they called robotics at the time. This was a study done, what was it, 15 years ago or whatever. it said that within the next 5 years, I think it is from now, anything between 94 and 99% of accountancy roles would be taken over by robots, AI. Particularly the ones which were rule-based, because just as you said, AI can follow rules very well, and it does it 60 minutes in every hour, 24 hours a day, 365 days a year, so you're not going to beat that. But what the jobs that, and it was done for the US, this report, the jobs that were much less vulnerable to AI were the jobs that involve people and personal contact. Because as of yet, it hasn't reached that stage of being as friendly, as able to sit down and have a cup of coffee with someone, as of knowing what the issues are that surround something. So do I think finance business partners or management accountants will be overtaken by them? I think the roles, the detailed transaction roles will be overtaken by them, and I think it would be no bad thing if they were, maybe from that point of view, because if we can spend our time actually adding value rather than adding numbers, then that's going to be much more beneficial. So again, what we're really saying is give to something that can do it better, those things which it can do, which is work with the numbers. Give to those who can do the other thing better, which is work with people and understand what it takes to get ideas put into action.
Brilliant. Okay, lovely, thank you. Have you time for more? You talked about to go through the various stages from analysis to impact. There needs to be a move from depending on technical skills to depending on more people skills. It's probably what you've been speaking about there. So what does that mean and why is that?
Yeah,
I'm just elaborating on what you've just been speaking about, I suppose.
I guess, yes. I mean, it is very much that. Our technical skills can and will be overtaken by those, AI and the like that can do things which we can't, and do it much more, well, hopefully much more effectively, but certainly in shorter periods of time. So yeah, we need to be able to get this part. The information is only the starting point. How to make information, turn it into action, is where the crunch comes in, and where many of us struggle because of the relationships we have and understanding we have of other parts of the business. The first day that you actually, I'm not suggesting you should, but the first day that you've actually got to start and go and sell to a customer gives you a different view of what a salesman or a saleswoman or a sales manager approach will be. When you firstly got to produce something about a time scale or get something delivered in a time scale which seems impossible, that gives you someone else's understanding of how they do their job. And I think it's that full round business understanding that it is important to what we do. Let's do what we could do well and accept that there will be things which come, no matter how much we like playing with numbers and spreadsheets, that will actually do it quicker and better than us.
Okay, brilliant. Thank you. And last one I see here just at the moment, you suggest benchmarking your business to look for opportunities to improve its profits. Where do you suggest getting this sort of information needed to do that?
Maybe actually, I'll just go back over something that I said. I mean, I found Plimsoll was a good source of telling me in our sector, or a sector that I'm looking at, what's the average return on sales or whatever for that sector, how many businesses are in it, and if you get their analysis, you can either do it by signing up and paying a few £100 for it, or if you have a development agency or something that can do that, give you the report, you're only allowed to take away a small percentage of it, but that's enough. Then you can get that information there, and then you go through and troll through their accounts. You go onto the CRO, you go onto Companies House, and download whatever you need to understand, firstly, the financial side of it. And then you sit with whoever it is, be it production or sales or whatever, and say, how could they be doing that? You know, one thing which comes out quite often is headcount. How could company A be producing that turnover with that number of people when it takes us whatever in relation? And you start to work out the ways, and you look for how they subcontracting it to somebody else, or a series of things in there, but you start asking questions, and they're not questions which will be answered from paper in front of you. They're questions by talking to people. I've been aware of people going, sitting outside factories to see what was happening. I know of people who have spoken to former salespeople from organizations to understand how do they go about things. There are ways of doing it if you look for it, and it would not necessarily be the accountant, finance manager who is doing that. It would hopefully be the people who would benefit from it, which could be the other functions that you're working with. But altogether, you know, it is being done. How are they doing it? Could we do that too? If so, what would we need to do that?
Okay, brilliant. Good advice. Good advice. Gary is saying, hi, Leonard. Do you see the balanced scorecard reduce in usage in both government and corporations, with a focus now on adding value measured by new measurements such as ESG?
I guess I don't know is the honest answer. I think there's a danger in many organizations that they've got far too many KPIs, or what they think are KPIs, but are just numbers. If, you know, ESG is one angle, and it's a very important angle, but it's only an important angle if your business is still surviving. So there will still be the name, be it balanced scorecard, be it whatever name we want to put to using measures that tie in with our strategy and how we reach that. And if our strategy includes our sustainability, which it has got to from the sort of the issues that we've got around us, then our measures will measure that. But we need to be profitable. We need to provide customers with the service that they want. We need our employees to be happy doing what they're doing, but know what they're doing in terms of the who, what, where, when, and how and why. So I don't see performance measures, be it balanced scorecard or whatever, going away. In fact, I think the very fact that we're talking about ESG measures shows that they're increasing. The increase in dependence on getting good reporting.
Okay, great, thank you. And there is one final one, but is it possible to get a link to the article on contribution-based activity?
I don't know about a link, but I tell you, I probably have a PDF of it somewhere.
Okay.
Yeah, I'll buy. I mean, send me what it is, and I'll give you. It's not. I mean, it was 1997.
Okay.
Management Accounting, I think, was the name of the journal at that stage before it changed to whatever.
Okay.
But yeah, I can do that, or I can point somebody to the author, and because there's a number of things
Lovely.
written
And
down.
I'll maybe put that into the follow-up email as well then
Okay.
for folks so everybody has. I hope that's okay,
Yep.
Declan. Thanks, Declan. Okay, so that's it. That's all the questions done. Thanks a million, everybody, for your contribution. Are you happy with that to finish up there then, Leonard? If we are done with questions.
I'm done, yeah. So yes.
Thank you. That's brilliant. Thanks so much. On behalf of CGMA Ireland, obviously we want to thank you for that presentation, and obviously the interaction discussion is really beneficial, I'm sure, for our members. And we really appreciate your time as usual. You spoke about the Finance Business Partner webinar that you did for us in March. So I'll actually include that link for the recording in the follow-up email as well, because there was some kind of comparisons or some information on that you referred to again, for those who hadn't caught that. So that's it. Thanks everybody for attending. Hope you found it beneficial. I'll send the recording, as I said, and the last one, and any links, whatever that Leonard thinks are beneficial. Thank you everybody. Take care.